Finally, some relief for South African financial markets and so for treasurers here in South Africa. The big moves have definitely been in the interest rate markets. Finally, we've seen interest rates easing. So our FRA rates, which is the market expectations of where JIBAR is going to be in 3, 6, 9, 12 months, whatever, you can see from the chart, just really shot up, finally coming off. Still pricing significant rate increases, 25 in November, a rate hike at every single SARB meeting next year. So a lot priced into the curve. We've also seen some relief in the Rand market. Dollar Rand's been trapped 1480 to 1520 for a number of weeks. Finally, as Risk-Aversion eased last week, Dollar Rand has come down quite substantially, actually, all the way to that 1460 mark. Can I get all the way to 14? Personally, I doubt it. So importers maybe want to be looking at the 1450 and below area to get in. While things are better, there's still a lot of risks out there. Last week, we had the US CPI print, a 5.4% inflation rate once again. So inflation pressures are still very evident. Where's the transitory nature that the Fed has been talking about all year? Inflation just remains stubbornly high. And more inflationary pressures in the system. Energy costs continue to rise very rapidly. From a South African perspective, it's the oil price that continues to rise, going to be feeding through into the November. Petrol prices, diesel and petrol, both expected to increase substantially, unfortunately. There is, however, a silver lining to all the negative news around the pressure on the energy costs. What we've seen over the past week is that coal export prices, past few weeks, is coal export prices from South Africa have started to rise substantially. This is a real positive for the Rand. If you look at the terms of trade, which is our export prices divided by our import prices, what we see is in September, that terms of trade, export prices coming down significantly. However, with coal prices running up, our terms of trade have improved due to the rise in the export prices. Once again, a very good signal for the Rand. Rand fundamentals remain good. Rand fundamentals remain strong. We're going to continue to have strong trade and current account surpluses. Over the past week, the RMB markets research team released their October chart pack. The chart pack includes a summary of all their key economic views. Just some key takeaways there. The growth outlook remains pretty much the same, so very solid 5% growth this year, but then slowing down in the next few years back to the structural rates of growth that we used to, that come from the Eskom problems, from regulatory issues, etc. One important issue in the chart pack is their view on interest rates. As I mentioned earlier, the market is pricing a November rate hike, very aggressive rate hike, so November and through next year. However, our research team has kept with the view that with inflation relatively contained, the SARB will only have to hike rates in July of 2022. So a very sharp contrast here. Our research team saying no hikes this year through the first half of next year. The market saying November, January, whenever it is, March, June, rate hikes at every SARB meeting. We don't have the dates yet, but practically at every SARB meeting. The research team, though, did acknowledge the slightly higher inflation environment and have added another 25 basis points to their rate hike trajectory in the second half of 2022. So they keep the view of the first hike coming in July, but as where they used to have one hike in the second half of next year, they now add two, taking the repo rate up to 4% and then up to 5% at the end of 2023. Crazy interest rate environment, very difficult for our clients. We held a webinar this week chatting about how clients who are exposed to floating interest rates, what they should be doing in terms of the interest rate hedging. A very tough environment. If you'd like to listen to the webinar, please reach out to us and we'll send you a replay of that. In terms of the week ahead, three things to watch. Undoubtedly, it's going to be energy costs. So the oil price, the gas price in Europe. Do we continue to see inflationary pressures there? If we do, this we'll probably see that return of risk off. That remains a huge concern. In terms of the data, we've got Chinese GDP out early Monday and then our local CPI print. For once, the Chinese GDP number is going to be relatively interesting. For years and years, the stats authorities have just reported a figure very close to the target of the government. So markets have largely just ignored the China GDP releases, although for obvious reasons, it should be very important for us. This time around, however, we know that China's economy slowed substantially in the third quarter. So the expectation is that they will actually report a slower rate of growth. Consensus is for around a 5% year-on-year growth rate to be reported, but quite a wide range of market estimates of where that figure is going to be. So possibly some market reaction to just how quickly China's economy slowed down in the third quarter. Our own CPI release, our markets research team is expecting 4.8% year-on-year rate. The market is higher at 5%. But this inflation print takes on a lot of importance. What we've seen elsewhere in the world, particularly in Eastern Europe, is inflation suddenly accelerating well, but beyond what the central banks and the market had been expected, and forcing central banks onto towards hiking interest rates and tightening policy. Now, our domestic interest rate market is pricing the same thing. The view coming from London and it's being fed, driving market pricing, is that the Reserve Bank may be behind the curve in terms of the inflation expectations, and so in terms of when they're going to hike rates. So if South Africa's inflation remains contained, we can have that further easing of that incredible, crazy pressure in our interest rate markets. However, if we get a higher than expected CPI print, that can really generate significant financial market moves, primarily in interest rates, but also spilling into the rand and other markets. Overall, sigh of relief in South African financial markets, a slightly better environment for corporate treasurers in South Africa, but still a lot of risks around, focused on the inflation risks and inflation. But this week we also get Chinese GDP and South African inflation data. Good luck for the week ahead.